I can feel it coming in the air tonight. Oh Lord, well, I've been waiting for this moment for all my life. Oh Lord, oh Lord. I can feel it coming in the air tonight. Oh Lord. But I've been waiting for this moment for all my life. Oh Lord, I can feel it coming in the air tonight. Oh Lord.
That's right, even a monkey can trade as a rock star utilizing the 13 market moves formula. Guys, in this video, I'm going to reveal something absolutely insane to you. Very critical material, so grab a pen and paper. We're going to talk about the bounce ratios, guys. Yes, 13 markets move formula invented the bounce ratios. They're not the Fibonacci ratios. There's something a lot simpler. That's why anyone can use it. So it consists of only 3 factors, and we're going to go in depth about each one of those to help you make sense out of this market. So in this video, we're not talking about bulls or bears. We're going to talk about cats. Dead cat bounces, guys. And the most important thing is the market keeps going higher and higher every day. Don't let the dead cat or the dead Fed, whatever you want to call it, don't let it fool you. Okay? That is the most critical thing you should be focusing on right now. We're going to take a look for a ton of historic charts, ton of historic analogs to help you understand what is actually going to happen next in this crazy market that's playing this dead cat bounce with us. Now, for those of you that are new, may not understand what the hell is the dead cat bounce. Guys, most traders view a dead cat bounce is a short-term move higher after the initial drop. So when you look at ton and ton of charts, it's going to look something like this. Typically, it's going to happen after an uptrend's been going on for a while. The market sets something that looks like a double top, then it drops, bounces, okay? But this bounce is not a real bounce because ultimately the market drops again. So it's just a temporary bounce in the market. Now, in this video, okay, we will dig deeper into historical charts of indexes and individual stocks to help you, number one, get better understanding of the best short selling opportunities based on the 13 market moves bounce ratios calculated from closely matched historic analogs, and number two, to help you identify the best entry for the next big short. So without any further ado, the pre-existing conditions for dead cat bounce. So typically, they're going to be portrayed in a double top or multi-top formation. If you've taken the charts diversity course, you know how important these topping formations are if you're trying to nail some highly profitable opportunities on the put side of the market. So with that said, it's important to understand that these tops are formed not just when the market is topping as in the ultimate top of the market when something is uptrending, but also those variations are happening when the market is in a downtrend and it's bouncing or plateauing and going sideways. So condition A is, this particular condition A is when market is uptrending, then it creates a double top or trade by these 2 dots, and ultimately it goes for a drop-off, which is the ultimate best opportunity of the short seller because this is the holy grail of shorting opportunities. Those of you that trade with us, you guys know that we've nailed the top in the market before it crashed recently, 30% in February, March, and April. So condition B, okay, now at this point the market is already downtrended, and as it drops, it sort of looks like it's beginning the uptrend, but a lot of these moves can turn out to be false, fake moves. They look like a real move, but it's not the real deal. So it's going to look like this. You can get a series of bounces. It's going to look like the market is heading higher just to set another top. So when we're talking about the stopping conditions, guys, the crucial aspect to understand is they can happen both when the market is uptrending and downtrending. So the time frame is also of crucial importance. The way we are calculating the bounces, they typically come in bounce A, B, and C. Sometimes when the markets make substantial drops, you will only get bounce A and bounce B. So in other words, the initial bounce followed through by a secondary bounce. In some instances, it will resolve in a third bounce followed by a drop. But in many variations, as you're going to see on these historic charts I'm about to present you with, guys, is you're often only going to get a variation A and B. So important to understand that if you are a day trader, you can definitely apply this information by switching the time frame on your chart. So the most critical time frame on charts from perspective of a day trader, look in the 1 day 1 minute chart, 1 day 2 minute, 1 day 5 minute, 2 day 2 minute chart, 2 day 5 minute chart. All those variations are crucial, and you will see the more chart patterns I'm going to show you in this video, that you will be able to spot them on a shorter time frame intervals, and overall use this information about the 13 market moves ratios in day trading. Now, typically when we refer to a day trading bounce, it would be sort of a market bouncing in the morning followed by a reversal that day. Okay, the number 2 type bounce, which is often going to be like a B-type bounce, it's going to be highly useful for swing traders because that bounce could be coming over the course of 3 to 7 days, and it could be followed by further sharp drop that could be happening over the course of 2 to 10 days. So as you notice, the primary characteristic here is your bounce time frame is going to be slightly shorter than the drop time frame. It's going to have a ratio about 2 to 3 or 75% of 100. So that's very important information right there, guys. So number 3 is the longer time frames that has to do with the overall major reversals in the markets. Okay, they could be highly useful for both day traders and swing traders and even longer term investors, because it's important for you, even if you're going long term with investing, to understand, okay, when is the better entry, because ultimately that is what makes you the money. So when we going through this video, we're gonna reference the time frames in days. So when you see something like a designation of T2 that actually tells you that the time frame equals to 2 days, T35 means time frame equals to 35 days, T60 means time frame equals to 60 days. Now, very important aspect I want to discuss at this point is the magnitude of the bounce in relation to the initial drop, because this is the area where I actually noticed a lot of traders, they misunderstand this part or they struggle with this, and it has to do a lot with the way you calculate the percentages. So for simplicity of this illustration, okay, this is not a real life example. It's close to a real life example, but the numbers are rounded off to make it easier for example purposes. So if we take a number of 3,000 and let's say from 3,000 level we drop 600, that represents a drop of 20% down to a level of 2,400. Now if the market goes up 20% from this point higher, you're not going to get all the way back to 3,000. You're only going to get to a level of 2,880, which is going to represent an increase of 480 points from the bottom. So in this case, this is one of the instances where 20 does not equal 20. So I have recently talked to multiple traders. They're like, well, what do you mean the market went up by the same percentage point as it dropped? We're still like nowhere close to the 3,400 level, or just on the 3,400 when we're hitting all-time highs a few months ago. So, and that's the exact illustration here that a lot of people are not understanding. So in this particular case, it would take actually a 25% increase in order to hit that level of 3,000. So anytime, or not anytime, but in this particular example, when the market drops 20% to a level of 2,400, we'll literally need to go up by 25% to reach that same level of 3,000 from where we dropped off. So in this case, 20 would equal to 25, not literally, but you understand what I'm saying, right? So basically it would require 25% bounce from the 2,400 level to get back to the 3,000. Now, it is important to understand this ratio as we're going through the examples in this video. I'm going to try to give you a few examples before we actually go into observing all these historical patterns. So 13 market moves formula has a basic bounce ratio that we use to help you calculate the significance of dead cat bounces on the chart. So before we move further, I'm gonna break this down for you. So a 20% drop followed by 20% bounce would give you a ratio of 1. So in this case, to arrive at 1, you'd basically take 20, the amount of the bounce, and divide it by the amount of the drop. Okay, to get to a ratio of 0.75, you take the 15%, the size of the bounce, you would divide it by the size of the drop. So 20% drop followed by 15% bounce would give you a basic ratio of 7.75. 20% drop followed by 10% bounce, guys, that's going to give you a basic ratio of 0.5. And 20% drop followed by 25% bounce would give you a ratio of 1.25. So in this case, clearly the bounce is greater percentage points, but it does not necessarily mean that it's going to be greater point-wise, because you're going to be working from a lower point of the lows where the lows were set. So before we move further, I'd like for you to answer a simple question. If you didn't understand this, just rewind the video and make sure you understand this part before you move further. So the question is going to be quite simple. I'm just really explaining you how to do this math. It's quite simple. Okay, what is the 13 market moves bounce ratio on a 10% drop followed by an 8% bounce? So type your answer in the comments. Okay, make sure you get clarity before you watch the rest of the video. All right, guys, the answer is quite simple. In this case, the answer is going to be 0.8. You would simply take 8 divided by 10. That's your bounce ratio of 0.8. So in other words, on a drop of 10%, the market is not only not compensating fully for the point drop, but it's also not able to regain the entire move in percentage points. So when you look on the chart, it's going to be like an incomplete V formation. So just looking at these numbers, okay, you kind of going to understand what is actually happening on the charts. So the next important thing is to transition from using a basic ratio to a weighted ratio, or the advanced ratio of the bounces, which actually takes into account the magnitude of the move as well. So in this case, we're looking at the basic ratio, which I just showed you how to calculate, and we're also taking into account the magnitude of the move. And the magnitudes, we break them down in 5 categories, okay? And M would stand for the magnitude of the move. So if the magnitude of the move, the size of the move, is up to 10%, we'd assign M1 to that. 10 to 20% would be M2, 20 to 30% M3, 30 to 40% drop would be M4, and 40% plus would be M5. Now, those are going to be highly, highly rare instances. So most of the time, you're going to be dealing with M1, M2, M3, and M4, and understand that the higher the number of the magnitude, okay, the greater your opportunity to earn if you understand what that magnitude could produce next. So understanding the magnitude of the drops and the way you split them is also important. And finally, the third component of this bounce, dead cat bounce calculation utilizing the 13 market moves, is to understand the dead cat bounce. Yes, or in other words, if you want to think of them as category of the storm, right? The storms, we divide them into category 1 through 5. Same thing if you choose to think of it instead of a dead cat bounce as a category of the storm. Okay, the storm that's about like a tropical storm that's about to go through the island. Okay, the intensity of the storm will ultimately dictate the damages that could be done to pretty much everything on that island. So the heavier the number is, the worse is the storm. So the bounce of up to 10% would be a category 1. 10 to 20 category 2, and so on. 40 plus would be a category 5 dead cat bounce. Okay, now here's some simple rules that you should keep in mind, that the greater the magnitude of the bounce and the shorter the time frame of when that bounce is actually taking place, then the higher probability of another leg down that is going to be of a greater magnitude. Now, also important to notice that drop after bounce B is generally greater than the drop after bounce A, but time frame can vary when it comes to after bounce B. Overall move lower, the time frame on that could actually vary, and generally it's going to be longer than the time frame of the bounce. So when you're picking out your time frame on your options, when you're picking out the strike price on the options, all of that comes into play. Understanding the size, the magnitude, the category of the bounce, it could help you calculate the ideal strikes, time frame on your options, and so on. So as we're going for these historic examples, guys, I want you to keep these 3 conditions in mind. Again, condition number 1 is the pre-existing condition. Remember when I was showing you the multi-top formation, the double top, both of these formations could happen in the uptrend and downtrend. Number 2 is the time frame of the move. How long does it take a certain thing to complete its move lower? How long does it take a certain move to complete its way higher to the ultimate point of the bounce? And number 3, the most important criteria that goes into calculating the actual ratio is the relationship between the magnitude of the bounce in relation to the prior drop that is preceding that bounce. Okay, so with that said, let me give you some examples of how we actually going to utilize this information. So in this particular case, as you can see, we're looking at totally different years, different time frames, and then we're really going to focus on analyzing some similar conditions. So for now, we're just going to glance at the chart of Tesla. Now, this particular chart is from 2015, and I want you to focus on this double top formation represented by this purple dots right here. You see we make this move lower from 285 all the way down to 240. Okay, then we bounce. So the first bounce, as we go for all of these charts, it's going to be called bounce A. Okay, so here we go from the red dot to the green dot. That's bounce A. So in order for you to calculate the actual ratio, okay, you would take the percentage drop from the purple dot to the red dot. Okay, you would take the percentage of the bounce, which you can easily take from the red dot to the green dot. You're going to take the bounce number and you're going to divide it by this drop number. In this particular case, when you do that, you're going to come to a ratio of 0.74. So, and it's actually easy without even calculating this. You can see that the move lower and the bounce is not quite as high when we're looking just at the chart overall as the actual move lower from this dot to this dot. Okay, this bounce is not as high. Now, sometimes the situation is going to be very close, so it is important to understand how to calculate these bounce ratios, guys, because sometimes it's going to look like this leg is almost, this bounce higher or this leg higher is almost the same size as the drop, but in relation from the percentage point, it could actually be greater. Okay, and if we're talking about a ratio that is greater than 1, it carries a very huge significance into calculating what's actually going to be taking place next. So in this particular case, we have a 0.74 ratio. Okay, magnitude 2, category 1. Okay, magnitude 2, category 1. Now, generally speaking, the greater these numbers are, okay, if you had like a magnitude 3 or 4 or magnitude 5, and if you had category bounce like 3, 4, 5, the higher these numbers are, the bigger the upcoming drop. Now, generally, when we refer to the indexes, the drops in the indexes could be smaller than the drops in actual stocks. So in this particular case, even though we're dealing with just a magnitude 2 and a category 1, you've got a drop of 25% within the time frame of 5 days. So basically, this drop from this green dot all the way to the red dot, that's a 25% drop, followed by a bounce B. So bounce B is the second bounce that happened. And as you can see, this one has a huge magnitude of the bounce. I mean, this is a very rare circumstance where after bounce A, you're going to have a drop that's going to be followed by a ratio of higher than 1. And in this particular case, it's like 1.68. So this is almost like an extreme example. It's typically not going to happen with majority of the stocks, but clearly Tesla is not your typical stock. So I've inserted this example to let you know that crazy circumstances like that will happen on occasion. So a ratio of 1.68, magnitude 3, category 5 in this particular case. So A, B, okay, and then you really, after that, you're pretty much done because that's when the uptrend resumes right here. So you got bounce A, bounce B, followed by a drop. In this case, after bounce B, we got a drop of 28%. The stock drops from 280 to 200 bucks, and the time frame is 20 days. So it's important to understand that generally, okay, your time frame on the drop after a bounce B is going to be larger. All right, so that's your example with Tesla that demonstrates the ratio of under 1, the ratio over 1, highly rare circumstance when the bounce is actually not like 1.1 or 1.2. In this case, it's like 1.68. Not going to happen very often, guys. All right, example number 2, Netflix, okay? You've got double top. You've got a 25% decline all the way here to the red dot, okay? And then you got bounce A. In this case, if you take a look at this, right, it looks like if you're just looking at the chart that this bounce is not as great in size as the size of this drop. But in reality, when you actually take a closer look and you divide and you calculate the ratio is actually 1.1. And you've got magnitude 2, category 3 situation top here. Okay, so that was followed by a 29% drop. So understanding that if your bounce is higher than 1 on the ratio, it generally will create greater size drops in majority of the cases. So as you can see in this case, it's followed by 29% crash. From 380, the stock drops all the way to 270 in just 11 days. So this is huge information because the right time frame on these options, okay, would have produced phenomenal return. And then you go into a B formation, B type bounce, and as you can see, the situation is incredibly lucrative here. In this particular case, we've got a 0.92 ratio, but look at the magnitude. The magnitude progresses to a magnitude 3, and the bounce progresses to a category 3. And so if you compare the move here, we're going from a magnitude 2, now we're transitioning to a magnitude 3 type situation. So when you transition into higher numbers from bounce A to bounce B, it tells you that there's further downside present in the market. So you've got to be alert to take action on this next leg lower. Now, in this particular case, Amazon creates a ton of opportunities. In this example, you guys clearly can see that we've got bounce A, bounce B, and bounce C. Okay, after bounce A, look at the numbers. We got 0.61 M2 Cat 2. On the next move, we actually progress into higher numbers. And that ratio now becomes from 0.61 becomes 1. You got M2 Cat 2 still, okay? But as we transition into bounce C, that number becomes over 1. Now we're talking about 1.19. Okay, so we've got from 0.61 to 1 to 1.19, and also your magnitude is advancing, M2, now you're at M3, okay, and as you can see out of all of these drops, right, you go from a 20% drop to a 21% drop to a 28% drop. So if overall these ratios are uptrending as you're transitioning from bounce A to bounce B to bounce C, expect a greater magnitude of the move to develop. So very critical information from the trading perspective here. Okay, in this case, we're going to take a look at example of BKNG. Now, that was a while back. Actually, at the time, ticker was in 2012, used to be PCLN for Priceline. So similar pre-existing conditions, right? You got double top. You got time frame of 30 days, move lower all the way to the red dot right here, followed by a bounce A, okay, all the way to the green dot. So you've got a situation here where you've got a ratio of bounce ratio of 0.68, magnitude 3, category 2. Now that's followed by only a 14% drop, but look at the time frame, okay, only 2 days. Now if you look at the bounce B situation, all right, now you're going from what you see how these metrics are increasing from 0.68 to 1.22, okay, and it is followed by a bigger size drop, okay, of 15.3. So here's an example of SPY. All right, we've got the pre-existing conditions of an actual severe downtrend. Okay, remember the two conditions I was explaining in the beginning of the video. Okay, so this one is the market is already downtrending. Okay, we've got pre-existing condition of a downtrend. You can see that we've got a time frame of 20 days where things are falling. Then finally we get bounce A condition with time frame of just 7 days. It drops with a time frame of 14 days. So anytime you see this type of condition, right, you got T7 going against T14, that tells you that this market is not done dropping yet. Okay, and this could be confusing, but this has very crucial and high level of application to the current situation in the market, because you can see from bounce A to bounce B, it looks like the market just erasing all the losses, right? Even without calculating the ratio, you can see that pretty much this move higher on the bounce B is getting you pretty much back to that initial point of bounce A. Now, when you look at the ratio, okay, even though this green dot is slightly below this green dot right here in bounce A, the ratio is 1.07. So the move higher here from this red point represents the lowest point on this chart after bounce A. Okay, this move higher is actually a greater move percentage-wise than the drop. Okay, and you've got a situation where you're going from magnitude 4 cat 3. Okay, it is followed by a 30% drop after this bounce A. Then you've got a situation on a bounce B to where the ratio is still over 1. The ratio is still over 1. And you've got about same metrics, magnitude 3, category 3, that is also followed by another 30% drop. But crucial detail here not to overlook is that typically after bounce B, yes, your magnitude of the drop could be even greater. In this particular case, they were each about 30%. But overall, this time frame is longer than the bounce time frame. So here we had 45-day bounce followed by a 65-day drop. As you can see in the prior case, after bounce A, things are happening rather quickly. You've got a sharp move lower of 30% within 14 days. So typically after bounce B, it does pay to increase your time frame on your options because things are going to be overall moving lower, but they could be taking longer time to do so. So the bottom line here is the greater the magnitude and the category, the greater the upcoming drop could be. So as you can see, the prior instances we're dealing with, magnitude 1, 2, category 3 type thing. Once you shift to this magnitude 4 and category 4 type scenarios, guys, you're positioning for drops in the stock you're trading or in the market by as much as 30% or higher. Okay, and all you need to do at this point is factor in the time frame within which that drop could be taking place to put on some lucrative trades. Now, here's the historical data, guys. Here's the best part of the video, because that's going to give you a lot of insight into how things progress historically in similar conditions to what we're going through right now. I simply want you to focus on the charts and trying to find similarities within patterns and time frames in order to be able to form your own opinion right now on the market, which, if you do your due diligence with this information right here, you will understand that generally people will tell you, don't fight the Fed. But in this case, if you pay very close attention to what I'm about to present to you, the conclusion is quite the contrary. You do want to bet against the Fed, because it is the Fed that is creating this dead cat bounce right now, and want to short the hell out of this dead cat bounce. So these are similar instances in the history, dating all the way back to 1929. Now, we're actually going to analyze the last 6 cases where the markets shifted into a bear market conditions. They lasted anywhere from 3 months up to 31 months. We're going to take a look at historic time frames of 1980 from 1982, 87, 1990, 2000, 2001, 2002, 07 through 09, and the September through December of 2018. Now, in some instances, those resulted in a recession. In some instances, we did not get a recession. So all of these criteria we're going to talk about in detail. Now, before we go look at this historic data, I wanted to basically give you an overview of what actually is taking place with the market right now. So as we're looking for this historic data, you have an understanding of what to look for in order to find some similarities. So overall, what we've got here is an incomplete V formation. Okay, overall, from this high point in the market a few months ago of 33.92, we've traveled all the way down to 21.74. And yes, on those days, right here at the lows, we were placing multiple videos telling people to buy calls. Yes, while everybody was highly bearish at the moment. Those videos are still on the YouTube channel if you want to review them. Now, at this level, we're getting very close to the 3,000 level. And actually, our target on that is 29.98. So if we get to 29.98, guys, it's going to resemble many charts I'm about to show you here that coincide with all these drops, all these historic drops over the last 30 years. The important thing overall is these drops are highly unprecedented considering the time frames within which they took place. So overall, from 33.92 down to 21.74, with a time frame of roughly 30 days, guys, presents close to a 36% drop. Now, if we reach that level of 3,000 tomorrow, I'm recording this on the 25th of May 2020, so we're likely to get very close to the 3,000 level in the markets tomorrow when the market opened. Today is a holiday, so the markets are closed, but tomorrow we could be within points away from that 3,000 number. And that would indicate that after a drop of a time frame with 30 days, we're getting a bounce with a time frame of 60 days roughly. That represents a 37% increase from that low figure of 21.74. Okay, so at this point, the bounce is greater, okay, than the initial drop. But we got to look actually a little bit more into it, because there's actually, within this formation right here, we already had bounce A that has taken place. So, but overall, keep in mind this incomplete V formation, because I'm about to show you what generally happens next when we look at all these multiple scenarios and historic analogs. Now, this situation right here, if we break it down just a little bit more in detail, okay, what happened here is we dropped from 33.92 all the way down to this level right here, represented by the red dot, so close to this 2,800 level. Then we bounced. We bounced all the way to this level of roughly 31.31. So this was our bounce A. And right now we're going through a bounce B formation. All right. From all the examples that you have witnessed so far, on a bounce B, if your ratio is above 1, it sets you up for a very strong move lower. And since we're not on a bounce C, which happens rarely, but it does, okay, the biggest drops in the markets, they actually happen after bounce B formation, which is exactly where we are at. So here was bounce A. This is bounce B. So far, if we were to break down what has taken place, all right, on this bounce right here has a ratio of 0.64 magnitude 2, category 2, that followed by a 30% drop. Now, overall, this leg right here from 33.92 to 21.74, it's about 36%. But after bounce A, that's what we want to measure in order to estimate the ratio of these bounce B. And so if we take the measurement from here, 31.31, subtract the 21.74, okay, and divide that number by 31.31, you will get a drop of 30% within a time frame of 15 days. All right, so this is a 30% drop that is actually preceding this increase higher of 37%. So that would actually give you a bounce ratio on the B bounce of 1.23, guys. Now that is very, very critical that you understand this part, okay? Because it's important how you relate to that information in comparison to historical data that I'm about to show you. All right, so let's start with a bear market all the way back from 1980. November 1980, August 1982, the duration of that bear market, guys, was 21 months, and indeed we did get a recession during that time frame. Now, if I zoom in, you will see an almost picture-perfect snapshot of the time frame that matches the current condition. When we're talking about the time frame, right, I'm talking about the overall move from the highest point right here, right after the double top, the pre-existing condition still in 1981. Here's the double top. Then we had for this huge drop off. And by the time we get here, it takes about 40 days. If you compare that to the current conditions right here, right, overall, we're working with a time frame of 30 days. So there's a 10-day difference, but overall, this is very, very close, considering we're like 40 years apart here. Now, the bounce here, in the current circumstances, we're roughly about 60 days. Now look at the time frame on the bounce right here. It is 60 days. So we got time frames almost matching perfectly right here, guys. What else is matching perfectly is the fact that we're in the same conditions when it comes to the death cross. Prior to this situation unveiling right here, before this drop, followed by this bounce, with a condition of the death cross. And another very cool condition, if I forward this to the next slide, guys, another crazy condition that is a picture-perfect moment is this right here. Look at this orange line right here. So the bounce in 1981 was exactly up to this orange line. Of course, the numbers were different back then, but the bounce was exactly up to this line after this death cross formation. So there's a lot of similarities on this chart, guys, including, the blue line being under the orange line, including this preceding death cross, including the fact that the market pretty much got right up to this level of that 200-day moving average at the time. So when we actually take a closer look at a longer time frame, that particular scenario was unveiling right here. Okay, so at this point, I've included a longer time frame chart with multiple months. So this is how this looks on a longer time frame chart. And look what happens next. So here's that. As soon as we pretty much touch that orange line, after bounce A, we get a huge move lower here, which takes over a substantially longer time frame. It takes like 120 days in the time frame, okay, within which the market falls 17%. Then we had for a bounce B, Okay, and then we're heading lower by another 17% lower from there. So, and look at where the bounce B actually just moves slightly over that orange line. The importance of understanding these is two things, okay? That even though we're not touching the orange line yet, we're fixing to do it over the course of the next 24 to 48 hours. And we could go into a scenario that could be a slight overshoot because we are on the B bounce right now. And as you can see, historically in B bounce formations, there could be a slight overshoot over that orange 200-day moving average. All right, so in this particular case, to make things a little bit more visible, this is what the 1981 scenario historic analog actually points to. So here's your double top formation right here. Here's your move lower. Here's your bounce A. This is the next move lower after that bounce A. And we got a repetition, a mirror image of that going into bounce B. Same size drop, same everything. So here's your dead cat bouncing right here, guys. Now, this right here has a huge significance because this historic analog actually points to a potential 30% drop. And yes, I did say 30%. As you can see, the calculations here point to a 17% drop. Okay, but the reason we believe this historic analog points to a 30% drop is because the market, as you can see after this bounce A, we move lower, the market sets a new low. Yeah, it actually goes lower. So in this particular case, we're going to have a scenario unveiling where the market could set a new low, which would be below that 2174 figure. So potentially it could be dropping all the way down to 2113, which would be a 30% drop from a 3,000 level, or about 3010 level. All right, moving on to the next bear market, guys. August 1987 through December 1987. Duration is 4 months. At that point, there was no recession. Now, this one does not match the current conditions very well. The magnitude of the drop initially was huge. Within just literally a couple of days, that drop was about 36% overall. Just on October 19th, the market dropped like 27%, right? The biggest drop ever in percentage points. So after basically that 35% drop within that week, okay, the market only bounces 16% within 60 days and 20% within 150 days. So we are already way over and beyond those type of conditions that were actually taking place in 1987. 1987, we got the bounces rather quickly. The drop was very severe, very fast, and the bounce came in just as fast. So here's your bounce A, took place literally within under 7 days. We got another drop, not quite as low, and we got another bounce B pretty much immediately. Okay, and then we got the follow through after the bounce B of about 26 days. So that bounce, the third bounce actually does not have a down lag. The bounce actually holds, but the market just goes sideways for quite some time, only gaining another 4% in gains over the course of the next few months. So these conditions are certainly not a mirror image of what is actually taking place now. The market has rebounded by way greater percentage points at this point that we're experiencing today in 2020. Now, 1987, guys, okay, to help you visualize this, this was this incomplete V formation. This was your dead cat bounce, okay? This was your bounce A, bounce B, followed by a fresh low that was set right here, or actually just a revisit of that same low. So, and after that, the bounce holds and will move higher. But the idea and the structure is pretty much identical. You get this incomplete V formation that is followed after bounce B into further drop. So drop after bounce B is greater in most cases and most instances, as you can see, everything I've shown you. The drop after bounce B is substantially greater. And then it takes guys, in this particular case, it takes 22 months for the market to recover all losses from October 19th, 1987, which is a total of 651 days. That's how long it takes for the market to bounce all the way to the level in September, October of 1987 before this crash took place. Bear market in July 1990, October 1990. Duration was 3 months, and there was a recession indeed at that time. So this is not an ideal match for a current situation. As you can see, the magnitude of the drops, they're way smaller than the present situation. There is a very critical aspect I wanted to share this with you, which is also incredibly helpful when you're day trading, guys, because a lot of these events, you're going to be able to see them on your daily charts when you're trying to jump in and out of your trades. So this pattern actually happens frequently. As you can see, in this case, we have bounce A, bounce B, and bounce C. The bounce ratio on bounce A is 0.41, magnitude 2, cat 1, basically a drop of 9.5% follows within 29 days after that. Bounce B is followed by 7.5% drop within 10 days. Bounce C is followed by only a 6.7% drop within a time frame of only 7 days. So there's 3 conditions that are met here. Okay, number one, the time frame of the drop keeps diminishing. So you go from a 29-day drop to just a 10-day drop to just a 7-day drop. So the number of distribution days basically is decreasing, and after a bounce C and this last few days of distribution right here, the market is changing its direction. This is how you can spot a trend reversal opportunity each and every time. So instead of the days, when you're looking at your daily chart, when you say you're trading off of the 1 day, 1 minute chart, okay, you can divide this into similar time frames, but instead of just days, you're going to have 29 minutes, you're going to have 10 minutes, and you're going to have 7 minutes. And this is how you can spot some major intraday reversals. Just apply this chart on a smaller time frame. All right, so basically what you've got here is when 13 market moves, okay, bounce ratio is increasing on each bounce, but the magnitude of the drop and time frame is decreasing, then expect a longer term uptrend to begin forming. In other words, a perfect case of a trend reversal opportunity. These are the time frame when you're going from a bounce A to a bounce B and a bounce C, and you have both the time frame of the drop and the magnitude of the drop are actually going lower and lower after each bounce. Okay, that tells you that the reversal is near. Basically, simply translated into English language, every time we're heading or attempting to head lower, there's less and less people that are wanting to sell at those levels. So that's why the number of distribution days or selling days is beginning to decrease, because there is less and less people that wanting to sell. When the market begins to drop, there's a lot of people that want to sell. When it continues to hit certain levels and the number of days on the sell days is diminishing before these bounces happen, okay, it tells you that the market is about to reverse. So very important information right here. All right, so similar condition. I wanted to point out this incomplete V formation followed by this reversal after, is in this case, you see a bounce. The biggest drop here happens after the A bounce. And then the size of the drops decreases. When the size of the drop decreases on a B bounce, this is your first signal that potentially the market is going through a shift from bearish to bullish behavior. Now, bear market, March 2000 through October 2002, the duration was roughly 31 months, and indeed there was a recession at the time. Now, this is another historic case where we're almost getting a picture-perfect scenario. We got almost an identical time frame match in the bounces that were taking place in 2001. So if we take a look closer here, you've got a situation where you've got the double top formation followed by a huge drop. You've got the A bounce right over here going from red dot to green dot. Not a huge bounce, but it is a decent sized bounce nonetheless. And then after this A bounce, you're going into a bigger drop and bouncing all the way to this level right here. So this is your bigger, grander B bounce type scenario. Now, this resembles the current conditions to a great extent, guys. So we've already gone for this A bounce, we've set a low in the markets, and now we've been bouncing for how long? 60 days. This is exactly what the time frame is right here. T60, guys, from the lows all the way to this level right here, it takes 60 days. And this time frame of the drop from here to here also matches closely. It's not a 30-day drop, but it is under 60-day drop. So it is still closely matching the current conditions. Now we've got a situation that also resembles the current condition from the ratio perspective. If you look at this bounce A, got a very small bounce, only 0.38 ratio with a magnitude 2 drop followed by just a small category 1 bounce. And in this case, it follows by a 15% drop within 11 days. Now, bounce B, all right, is huge. Look at the ratio on this bounce B, guys. It's 1.4, magnitude 3, magnitude 2, I'm sorry, cat 3. And then, as you can see on the next slide I'm about to show you, look at this magnificent drop right here. It is unbelievable. Look at this. Here's your bounce A, bounce B, and look at this huge drop right here. Now, notably, the time frame on the drops after bounce B, as I pointed out earlier, I just want to reiterate it one more time, it does tend to increase. So the bounce was happening over 60 days from the low point right here all the way to here. The drop is substantially greater in percentage points and in total points than the bounce, but look at the time frame. It's 96 days, guys. It's a much greater time frame. So 2 to 3 basically is the ratio here. So this is a very important chart for you to look at, actually both the detailed chart and this one right here, because if you focus on this and you study this, guys, this gives you the answer to how bad things could actually get based on these historic analogs. This chart right here tells us that we could be dropping off by as much as 48.1% in the next 96 days, and S&P could be trading at 1557. I know, guys, what you're thinking. There's no freaking way, Leo, this is going to happen. Oh my God, I know you predicted the last crash. I know you predicted the crash in February of 18. You predicted another one in September, October of 2018, but damn it, this one right, buddy, this just seems too freaking unbelievable. Come on! Guys, it is not unbelievable. What was unbelievable is this 36% crash we just had within 30 days, right? Nobody wanted to believe that. Nobody wanted to see this coming. So everybody's highly bullish right now. There's a lot of conditions that are being met, which we're not going to discuss in this particular video, but bottom line, just focus on this chart. Okay, history points that at 48.1% could actually be a real drop that we could be seeing over the course of the next 100 days here. If you're a short seller, this could be the ultimate opportunity of a lifetime. Oh yeah, and by the way, if you're wondering how we're coming up with this figure of 48.1%, so this bounce B right here is 21%. It's followed by a drop of 27.5% only, but we're using a figure of 48.1%. If you measure the increase between the bounce and the drop, it's 30%. So the difference between 21 and the difference of, this drop of 28%, the difference is 70. Take 70 divided by 21, guys. It's 30%. And so if you apply the current condition, which we're up at 37%, you take and add extra 30% to that, that's how you will arrive at a figure of 48.1. So I know it sounds insane, guys, but it could actually happen. So I think it's important to pay to the market conditions, specifically utilizing this chart because it highly resembles everything else that we're seeing right now. So again, take a closer look on this chart right here, going May 2001. And I mean, look, even the months, coincide pretty much day to day. I mean, look, the crash happened in March just now, right? Look, the lowest point was set in March. Look at the size of this bounce, all right? I mean, it pretty much, that's 60 days that we're going through right now, pretty much from March lows through the end of May. Look at this chart. It pretty much, this bounce B goes all the way through the end of May. But this is not the current chart I'm showing you guys. This is the chart from 2000. This is the chart from May 2001, right? And this is what happens next, right? This is May 2001, and this is what happens next. So to help you visualize this from the standpoint of the dead cat bounce, here's what you got. You got incomplete V formation. It looks like just like the chart I've been showing you from now, 2020, to where the market makes this wild move of roughly 37% higher from the lows. Okay, percentage point, it actually is exceeding percentage point of the drop from the all-time highs. You can't quite see it on the chart. It looks like we're still, this move higher is lower than the drop here, but in reality, when we look at percentage points and the 13 market moves bounce ratio, we already know that that has already exceeded this condition. That is what's telling us, it's this bounce ratio, guys, that is telling us that we're so close to one of the biggest reversals in the stock market history. History is made by looking at these charts, utilizing the 13 markets move bounce formula. Now, bear market, 2007 through 2009, duration 17 months, and yes, there was a recession at the time. Conditions are quite different from the current conditions. Nonetheless, you've got the bounce A, bounce B. Some of the time frames are matching somewhat. The pre-existing condition was a severe downtrend, double top, drop off for 38 days, bounce on 7 days, another drop for 20 days, bounce at 40 days, and then a drop for 60 days. As you can see, the conditions where the bounce, the B bounce, it does take longer, and when the drop off after the B bounce takes place, it also happens within a longer time frame. Okay, these conditions, they keep repeating themselves. And also that the magnitude of the drop after bounce B, it tends to be larger than the typical drops that we see on bounce A. In some instances, they have matched the drop after the bounce A, but in most of these circumstances, the drop after bounce B is actually greater, guys. So here's how it looks. If we were to draw again, this incomplete V formation shows up. It looks like the market is still not bouncing but quite as high, but in reality, okay, we are already there on the bounce ratio, and this is what happens next. Boom, huge fallout. Just when everybody's so used to this bullish market, right, reverse and everything is good, boom, that's where the next leg lower happens. Bear market, September 2018 through December 2018, duration is 3 months. There was no recession clearly at that point. This is quite different from the chart that we're looking at now in 2020. Everything from the size of the drops to the bounce ratios, everything is quite different. And honestly, this is very a rare type chart. This is not a typical chart. Sometimes this is not a typical chart of the indexes. You will see this happen in multiple instances with stocks, but this is not a typical circumstance for an index to be showing us this kind of stuff. So typically on the third try to break lower, the index will bounce. That would be a higher probability outcome, but in this case, it coincided with this death cross formation. This is where we got the biggest drop right here. Now, what was pointed out to a fact that we were indeed heading to a bigger drop is, notice the situation right here is we're going through the ratio. The initial ratio was 0.54, then it literally doubled to 1.08. So this huge increase in the ratio, okay, actually resolved in a much bigger drop that followed the bounce C, okay, setting up a situation where typically in the C, we don't see that big of a ratio, right? In a C-type situation, we typically see a very small ratio, but in this case, it was almost at a 1. So we started out with a 0.54, and we had basically a solid match, 1 and another 1, which resulted in almost a 17% drop right here, guys. So to help you visualize this a little bit better, here's your incomplete V formation again, your dead cat bounce right here, and followed by a magnificent drop afterwards. Now, the summary of this in application to the current circumstances is quite simple, guys. The two historic charts that we have matched as far as time frame, the pattern, and pre-existing conditions and everything, they point to a size or magnitude 4 and magnitude 5 type drops, which magnitude 4 and 5, to remind you, it's a drop anywhere from 30 to 40% plus in the overall index or the overall market. Based off these matches that we have found out in the historic analog, this could actually be taking place anywhere from 60 to 120 days going from now. Again, today is May 25th, 2020. We could see some substantial moves lower in the markets overall over the course of the next 3 to 4 months right here. So the question remains to be is whether the magnitude of the drop is going to be an M4 or M5, whether the time frame is going to be T96 to 120. Okay, so there's a variation there. And the ratio itself, I want to give you a word of caution, okay, because if I've shown you the very first example on Tesla where it had a bounce ratio of 1.68, okay, right now we're already in a very unique situation in markets where we have a bounce ratio of 1.23 within a very short amount of time. Now, the word of caution is that bounce ratio could actually expand all the way up to 1.46. Okay, that's actually going to put S&P 500 at 31 before this big drop could actually begin. So we're literally within about 20 points from possible top of a level of 3,000. We could still do an overshoot, as I was pointing out in some of the historic charts there, and possibly get to a level of like 3,010, 3,020. But as the word of caution, okay, the drop may not initiate right there and then. The market is rather resilient. Everybody thinks the Fed is going to save the world, which the charts point to exactly the opposite outcome in this type of scenario. Okay, so expect that this ratio could be expanded to 1.6, and the drop may not happen instantly or begin to happen this week. Okay, so the key takeaways from this video are simple, guys. Based on the 13 market moves, bounce ratio, calculating utilizing the two closest matches from the historic analogs, there is an elevated probability that the market could crash anywhere from 17-30% all the way to as much as 48.1% in the next 96 to 120 days by October 2020. Okay, an overall bear market in this case could last anywhere from 21 months to 31 months. We're already a few months into this. If you would like to know the details on how to best trade this type of market move with options, click the link below. Take action now. Do not miss on what could be the biggest trading opportunity of your lifetime. Let's roll. I'll catch you guys on the next video soon. Let's trade.